what kind of diversification is needed to confidently invest in ETFs. That's something we're going to flesh out in this video: diversification across businesses, sectors, asset classes, fund managers, geography, strategies. We're going to get to all of that. But first, we got to start with the basics, the 101s of the world when it comes to ETFs. Now, for the followers of this channel, this is going to be pretty rudimentary, but we also want to try to help out the brand newcomers, the people who have just maybe started following this channel, maybe who are just new to investing in general. Why would anybody want to invest in ETFs? Like, forget CoveredCall ETFs. Why would anybody want to invest in ETFs? Well, I'll speak out of experience for myself. I roughly started my investing journey about 4 years ago when I was 30. And I was on the cusp of turning 31, I started stock picking. And even though I really enjoyed it, from reading quarterly reports, trying to figure out qualitative, quantitative measurements of leadership teams, and using all kinds of different websites to, try to, in my mind, try to get an edge on these companies. And naturally, when you're newer, you kind of feel like, in a way, you've discovered something nobody else has. It's just not true. That's not a thing. Many of these bigger, larger entities that are managing trillions of dollars, they got everything in the market cornered. There's nothing that you've thought of that they haven't already. So even though I enjoyed it, but I realized that if I wanted to do more of this and stock pick more, I would just add naturally more to my plate. That would require me to spend more time trying to stay up on the news of these companies and quickly change if there was any sort of issues. And I quickly learned within that first year that being a father of 3 and married and all kinds of responsibilities in my life, that wasn't for me. Even though I enjoyed it, that's not what I thought would be the best choice going forward. So naturally, that kind of led me more to an all ETF approach. Was really to be more hands-off, just because it's easier to manage. I'm essentially paying someone else to manage these funds for me, for these other ETFs for me. And I like that idea that someone else is going to work for me to keep tabs on these businesses that I just can't do while I'm at my day job, where it is someone else's day job to do that thing. So naturally, I kind of like that a little bit more. And also too, it's just automatic diversification, where naturally an ETF is an umbrella that just covers a multitude of stocks, multitude of businesses, and across many different sectors if you really want it to. So I like that idea. So that's really, for me, why I got into it. It was just easier. Another Canadian YouTuber, I know many of you, I'm sure, have heard of Brandon Beavis. He's got 200,000 plus subscribers on his channel, Canadian focused material on finance. And I know he recently went to an all ETF approach. And again, he clearly loves stock picking. That's the apple of his eye, so to speak. But naturally, he's trying to grow another business. He's got family responsibilities. There's a lot there. So something that can just kind of play in the background would really work well for people who naturally have other things going on, maybe other things they want to pursue, other hobbies, other ways of building wealth, starting businesses. Being able to invest in ETFs is a tremendously important thing. It's a great thing. Okay, so now that we got that out of the way, let's look at some other layers of diversification. Let's go. So one of the very first layers of diversification we can talk about is fund manager diversification. So we'll quickly run through some of the different CoveredCall ETF fund managers, just so that you can be aware if you're not aware already. So we got Hamilton ETFs, Brompton Funds, Global X Canada, Evolve ETFs, Harvest ETFs, Purpose Investments. There's also BMO and CI Financial, and along with actually JP Morgan and Invesco, which are American firms now listing CoveredCall funds on the Canadian stock exchange on the TSX 60. So, maybe Canadian fund managers should maybe try doing the opposite, since you all have a lot of amazing funds up here. And you guys have done some things up here in Canada that clearly the Americans, I don't know, they got their blindfolds on or something, because a lot of Canadian firms are doing a really bang up job up here and being innovative in a way. Let's also discuss, so why does it matter? Fund manager diversification, you just saw a whole host of them. Why does it matter picking a bunch of them? Well, a lot of it comes down to qualitative measurements. What is the makeup of the leadership team? Who's running these funds? What's their experience like? What is the goodwill surrounding these fund managers? How does their reputation precede them? How do they interact with investors, whether it be through webinars, workshops? How well do they respond to questions? Or even phone calls, or even better yet, interviews. So yeah, how do they make themselves available? And I think that's important, and especially how innovative they are. How quickly are they coming online with new products? Not to say quantity is better, but are they the big one is, are they innovating and trying to truly make a better product out there? So yeah, like I said, different exposures to different leadership styles and experiences. Now that's obviously very hard to kind of judge when you're not inside these companies and getting to know these individuals yourselves. But for me, it really just also comes down to a hedge against incompetence, right? Or if something happens to the fund manager where their company goes under, then at least you're not forced to sell off your investments before it goes under at a set price. Whereas maybe if there's maybe a 30% allocation, well, at least it's not 100%. So I think in the early going, if you're new to CoveredCall ETFs or just ETFs in general, I think, yeah, you'd start with one. And I think as you build up experience, whether that suits your goals, your lifestyle, whatever it is you want to invest in for the long term, short term, then that's really a time to really maybe think about different fund managers. But at least to start, just worry about one. Okay, the next one we'll talk about is asset allocation. So these would be things like bonds, commodities, fixed income. All right, well, fixed income is bonds, right? Equities, so being, owning things like Amazon and Meta and Netflix, things like that. I think BMAX is a really good example of this, right? The Brompton Enhanced Multi-Asset Income ETF, where they invest in fixed income, different layers of equities in here. They also invest in split share funds, which is not something that this channel is focused on, or fixed income really for that matter. But having these different layers of assets is, for me, that's why I like to own BMAX, is because it has that sort of unique different asset allocations inside of it. But that is just something to think about, different assets. Now you can also think about sectors as well. I pulled this up from Blossom. I know many of you all use Blossom. And just to see, the sectors I'm invested in versus what the average, I guess, Blossom investor is invested in. Actually, when I saw this, I was actually pretty surprised by this, in bringing some, bringing some extra, information to this video, that I feel like I literally am on the opposite side of what's normal. But if you want to, maybe you consider yourself a growth income investor, or just a growth investor in general, one thing to be aware of with ETFs is you might be maybe unaware, or maybe you are aware, you might be developing a natural interest in macroeconomics, meaning kind of the big picture. and different cycles and trends, like when sectors do well under what conditions, when there's inflation, when there's interest rates, when there's war, right? Or when interest rates are low and the Fed is just pumping money into the system. Like what sectors are doing well when it comes to that? Understanding like in what countries, what sectors tentatively do outperform compared to everything else. So in my case, in my TFSA, just in general, my whole portfolio is really US based because that's where most of the growth is going to come from. So what sectors in the US tentatively benefit the best from a growth strategy? And that's typically technology overwhelmingly, followed by healthcare. Here in Canada, much more cyclical. We tend to focus more on financials and energy. Not as growth driven, but there's a lot of this. Actually, I think that kind of environment is great for a cover call strategy, especially if you just want to reinvest over time. I think there's a good chance that you can certainly outperform potentially the Canadian market doing that. What this actually tells me is that Blossom is a Canadian social investing platform for finance, obviously. But it tells me that a lot of you are invested in Canadian stuff when, if you're wanting the growth, you got to go where the growth is. And that's going to be in the States. That is the economy, right? That's the equity driver of the world. Even in kind of weird and wacky times that it feels like we're living through, that's where it's going to be. It's probably going to stay that way for many, many, many years to come. So just something, maybe just call it food for thought in this circumstance. Okay, so moving on from that, we want to now maybe look at geography, something I just recently touched on, but I made up this little chart just to give you all just now this represents my TFSA, so what the geography breakdown of my own portfolio looks like. We can see here in the green, it is overwhelmingly United States based. If I included my spousal RSP into that, like the orange, the light green, and the blue would shrink that much more. But for TFSA purposes, just the TFSA, almost 70% is US based. Next up, Canada. Naturally, there's many of the funds that these fund managers put out is either very US focused or very Canadian focused, naturally. And then we round it out with developed markets, 8%, and then emerging markets, just a little 2%. Now, you might be asking, why even bother with those if I'm so confident the U.S. market will do so well long term over time, markets will always rise. Well, again, investing across different geographical regions, it's a hedge against, say, my own maybe hubris towards which country I think is going to do the best. I still want overwhelming exposure to the US, but I still want to kind of hedge against that potential with different geographies where, as I said, different sectors kind of rule the roost. And you also get exposure to many different companies that maybe you wouldn't otherwise if you were just strictly 100% US based. But I do think overall the US is by far the best market to invest in if you want some growth in your strategy. And that even includes your CoveredCall ETF strategy. I'm much more balanced in that approach. I'm not just seeking yield. I do, as I like to say, I'm yield seeking, growth leaning. So I do want some growth in my portfolio naturally, and especially right now, I reinvest absolutely everything. Next year, I will have some tangible use cases for that distribution income. All right, so now that we looked at diversification across businesses, fund managers, geography, we got to talk about diversification across strategies. So let's discuss that. What we could do is maybe we'll start with maybe we'll start with Hamilton. Why not? The one thing, this is probably the most interesting layer of diversification for the ETF nerds out there like myself. The CoveredCall landscape, like none of these funds are created equal, contrary to what, you know, some rando on Reddit or any other social media site might say. None of these funds are created equal. They are so different in many different ways. Some of these CoveredCall ETFs hold one fund, and some hold 500. Some are index-based. Some do a stock selection. So we can let's start with a fund like SMAX. Actually, this might be a good example. Now, SMAX represents 65% of an underlying holding of HYLD. So HYLD holds a bunch of other ETFs, right? It's like an inception ETF. It's an ETF that invests in other ETFs. And so what does SMAX invest in? Well, it's the Hamilton US Equity Yield Maximizer ETF. It's trying to mimic, you know, basically the sector mix of the S&P 500. It's, again, not an exact science, but that's what it's really going for. It's kind of more of an S&P 500 style of fund. But unlike the S&P 500 that holds 500 companies, SMAX holds, whatever this is, like 25, 30 companies, something like that. And they're all equal weight. So these are some of the biggest companies out there. And they're writing individual call options on all of these. Now, something I just learned from that Adriano Q&A with the chief option strategist over at Hamilton is that, which I didn't know, and I actually think it's a really great tidbit of knowledge. And it goes to show why HYLD has been such a overachiever this year. And that is Hamilton ETF strategies with all of their yield maximizers that you can see here. They write individual calls on each of these funds, where other fund managers out there might write call options on a full index versus individual companies. But what this allows, I guess, Hamilton to do is they don't have to write as much call options for coverage on the portfolio and still get a higher yield. So basically, you get more yield with less CoveredCall coverage on the portfolio because they're writing on individual stocks. Also, too, because this isn't index-based, it has a chance to overperform because it's much more concentrated. And the more concentrated you get, the higher of a chance of overachieving. But also there's a higher chance of, like underperforming the index if things go south. So I think that makes that really sets Hamilton apart in that respect. Whereas, say, Global X, they have a bunch of funds that are all index-based. So you get the S&P, 500 with, say, something like USCC. So you can invest in the S&P 500 with cover calls. You could even do it with a leverage. I mean, that's also a great option too. You want to invest long-term in the S&P 500 with 25% leverage. I think the leverage over time, if you believe markets are going to go up, that'll be your friend, not your enemy. Okay, so like those are two vastly contradicting not contradicting, but just quite the different sort of strategies. One's very index-based, one writes their own call options. Harvest is kind of maybe a little bit more like Hamilton in that respect, that they write individual calls. They're kind of putting more of their own stocks together inside of various products. There is just a plethora of different strategies. Some of these fund managers will only write up to 30% CoveredCall coverage on the portfolio. They'll do out of the money, in the money, out of the money. Like there's all these different terms, and that you can certainly, if you binge watch my videos or others talking about income investing, you can get up to speed on the language. But for me, I like to invest in basically all of this stuff on all of these strategies based on the geography, the fund managers. I hold 4 different fund managers. I think in my TFSA right now, although I don't have a little drawing for it, but I believe Hamilton ETFs represents 40%, Harvest ETFs represents 30%, Global X represents 20%, and Brompton Funds represents 10%. So that's where I get my fund diversification, my fund manager diversification. That's where I showed you the geography diversification, exposed to different strategies. These are ETFs that invest in other ETFs. So I basically cover everything as far as that's concerned. But for me, that's what excites me. That's what I really want. I feel like for my own knowledge and what I've seen so far with kind of testing various layers of this portfolio and different aspects. I once had some more sector funds in there, and I'm finding like the performance level of the all-in-ones seems to be doing a really good job of a balanced approach, giving me diversification of, once again, yield and capital appreciation as well. And they basically work almost in a weird equal harmony. I think year to date I think on average I'm up about, price-wise on the ETFs, about 14%, but my total return is roughly around 28. So I am and beating the other indexes. Something I didn't think I'd be saying in mid-October of 2024, that a CoveredCall ETF portfolio would be beating the market, but I don't know, I guess weirder things happen. So hopefully you all like this video, got something out of it. So as always, hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.